Dear investor, in this edition, let us discuss the following. 1. Result season trends in numbers and market reactions to them. We believe calendar 24 could see the same growth paces perform as in calendar 23. Which investing style is working in the market, and do we see baton passing to another style during the year? Third, valuations in various parts of the market and sustainability of the same. On the first topic, result season takeaways. CY24 could continue to see many of the same spaces perform strongly for growth investors. Now, early trends in IT services result do show that large cap IT services growth in profits is significantly lower than the profit growth registered by mid and small cap IT services companies, generally speaking. Successful mid cap IT companies are focused on verticals which are having tailwinds, while large caps are present in all verticals, and of all the verticals, some would be headwinded in a slowing economy. In large consumer companies are finding difficult to deliver volume growth. This is a year again when, on account of lower IT services job growth in this quarter, top 4 companies probably shed 50,000 jobs, and lower growth in government spends. If government opts for fiscal consolidation, consumption is going to be headwinded. However, in the consumption space, luxury consumption remains strong on wealth effect of buoyant real estate, equity and gold prices. In this space, jewelry companies and premium builders have shared encouraging growth numbers, while retail results are yet to be declared. Third key observation is that banks have barely maintained NIMs. This is the first quarter where this has happened, and there are expectations of further NIM decline in subsequent future quarters. Deposit growth remains a challenge. Some banks have reported increase in deposit rates, which would pressurize NIMs as we go forward. As a house, we have had a significant underweight position in banks and have opted to be with high AUM growth banks to support, to enable PAT buoyancy. Results of higher growth DNA banks have been largely in line with expectations, while banking as a pack have had a very weak month. Larger capex companies are yet to declare results. Some smaller capex businesses, particularly pipe companies, have delivered good results. Order book buoyancy has been witnessed across the board. Those numbers happened through the quarter as well. While there could be a lull in the pre-election period and growth in government spending on capex could be lower in the new fiscal on fiscal consolidation, as government tries to reduce fiscal deficit from 5.9 to 4.5% over the next 2 years. We believe that private sector ordering, PLI related capex and import substitution capex would help keep buoyancy in the space. We discussed this in detail in the last session as well. Coming down to the next topic, which investing style is working in the marketplace, how would it be going forward? From the bottom of COVID, we have seen value style of investing has been working very consistently now for 4 years. The same style worked in the month of December and January also. For example, tech services space is no longer a high growth space, and it performed well. Similarly, a large part of the PSU space is seeing strong traction. Here we do note that in the PSU space, smaller companies are now seeing stronger performance versus better names in this space, which does point to the deep value that was there in the market slowly exhausting. We are exponents of high quality, high growth style of investing, and our portfolios reflect high growth themes like China Plus One, renewable energy, new tech, electric vehicles, hospitals, etc. Focus on the highest sustainable growth spaces has helped our portfolio outperformance in calendar 23, and we remained competitive thus far in the month of January. We believe that as the interest rate reduction cycle sets in over the next few quarters, this style of investing would increasingly find favor, more so also because value itself is becoming scarce. What would drive growth in earnings as we go forward? This is a small snippet that we want to focus on. The big jump in earnings from base effect is probably behind us. Going forward, factors which drive earning growth, would have to be sales growth itself, operating leverage, taxation reduction, if any, and yes, margin expansion. As we go forward in the new year, we believe that some of these factors which provided tailwind in the past, such as taxation reduction, have played out. Key driver for sales growth is the growth in the economy, which is being projected to be similar in 2024 as was in 2023. For the listed space, we to do relatively better. Shift from unorganized to organized should continue. That provides a tailwind. That is a value migration theme that we are very closely focused at. With the reform intensity continuing to be strong, we believe this shift could continue and should help listed space deliver double-digit sales growth. Some operating leverage should kick in with growth as capacity utilizations level improve further. Margin expansion has been the story of earnings growth in 2023, and this factor could continue to drive profits next year as well. Margin expansion could take place on lower inflationary conditions and also take place on account of better protection that is being accorded to the industry globally on China plus one sentiment and reverse globalization sentiment, which is sweeping around the world. It helps that our PAT margins are significantly lower than what we have seen in the 2005 to 8 period and have some room for expansion. Coming down to valuations in various parts of the market. Today, market is sanguine about the valuation on the larger cap part of the market. Larger caps are trading close to long period averages on 1 year forward earnings and seem very sustainable. We agree on the same. Now, general consensus on the mid and small cap part of the market is that this part has seen a very strong price growth over the last year and now trades at a premium to long period average, and the valuations are stretched. Here, we would like to point out that long period averages do not do justice to mid and small caps, because in the 2008 to 2021 period, the small and mid hardly saw earnings increase, and on top of it, earnings were very volatile as well. The reasons were many disruptions that the economy saw in the period from domestic and global factors, which larger companies were better able to handle, and also, yes, the onslaught of globalization. Averages hence are lower than potential. If we see the period from 21 onwards, mid and small caps have delivered much faster earnings growth versus the larger cap part of the market. To our mind, this is on account of reverse globalization and China plus one sentiment sweeping across the world, and also the strong support which Government of India is extending to the corporate world. Till it sustains, we believe that the new ecosystem that is being created to enhance domestic manufacturing capabilities and fuel import substitution, driven by newer breed of entrepreneurs, would continue to provide earnings growth, which is higher than the larger cap part of the market. Our thought is that if growth delta in the small and mid part of the market sustains favorably versus larger caps, their valuations would also sustain. We see a good chance of this happening. On the flows side, strong sustained flows in the SIP book, which is more directed at the mid and small part of the market, would also help sustain market valuations in this part. We hence continue to believe that this is time for alpha. A question which is often asked to me is, at this juncture, what are the risks that we see? We covered the risk in the month of November last year. Happily, many of those risks got addressed in favor of the economy and hence in favor of the market. Going forward, what may happen is, contrary to the expectations of strong FPI flows in the new year on reduced US bond yield. Well, it may not happen. In the month of January, it has not happened. US bond yields have, which dipped below 4%, have again moved over 4%, and FPIs have been strong sellers. US continues to run large and expanding fiscal deficit, and this would require financing. While the US Fed continues to taper down money supply as per its own plan. This would prove increasingly more difficult as we go forward and create risk to the thesis of lower interest rates providing tailwind to FPI flows. One way out is the Fed stopping taper and again starting to buy government securities. In spite of all the rate increases in the US, the economy remains robust and unemployment percentage remains low. This factor also can postpone Fed rate cuts, and the pace of cuts can be slower than expectations, and with consequent impact on valuations. And moreover, rate cuts themselves can be seen as a response to evidence of slowing economy. As things happen, the outcomes can be very different from what is expected in anticipation of them happening. Many parts of the world are seeing conflict. So this is a risk. Conflicts which were earlier confined to Russia, Ukraine have spread to Israel, Palestine, and now even the Red Sea area is seeing hostilities. This could endanger supply chains and disrupt trade and result in inflation spikes. Oil price spike could stretch our fiscal situation. Inflation spikes could force central banks to continue to have higher interest rates for longer. Lastly, one risk that we see is that while FPI flows have been intermittently strong for us, more stable FDI inflows have seen a slowdown. Number of unicorns are lower than last year and is definitely impacting startup sentiment. In the end, summarizing, overall, we believe in a good possibility of rate cuts and continued buoyancy in Indian economic growth, and believe that margin increases would be a key driver of profit growth even this year. Fiscal consolidation by the government may not impact as much as households and corporates take up the baton for capex. Valuations have caught up but are defensible, and near earnings growth returns should be expected on the index. We continue to believe that higher growth outside of index should provide alpha generation tailwinds to managers. With this, thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.